Hey YouTube, welcome back. Nice to have you with us. And today we're talking about successful trading 101. Hey, finally some meat and potatoes. All right, here we go. All right, let's imagine for a minute that you have $100 stock or coin. So you bought a coin or a stock for $100 and it suddenly drops 50%. You now own $50 worth of stock, right? So you lost 50%. That equals $50. Now, how much do you have to gain to get back to your $100? Here's some wonky math for you. To get back to $100, you need to gain $50. But because you only have $50, you have to gain 100% of that stock or coin. Hey, are you telling me some funny math here? No, that's the way it works, sadly. So you know it's faster to drop a stock, but slower and harder to climb it. Hey, it's Brad, and welcome back to Brad's Bread and Butter. Nice to have you with us in our little financial community here as we grow and talk about finances. So thank you to those of you that have subscribed and liked, and hit that little bell for notifications so that you get notified when we put out another video. And leave a comment. We'd like to know, do you have a story of trading stocks that's gone good or it's gone bad? Yeah, we'd love to hear. So tell us how you're doing as well. All right, so here we go. We're going to talk about a trader today. So a trader buys a stock at $100. And if that stock goes down to $80, he goes, I'm going to buy some more. Okay, so he bought on the way down, and then the lower the average, the price goes down, it goes down to $60, and then he buys again. That's called dollar cost averaging. Okay, so he's buying on the way down. Okay, but it's better to close a position in the red than to make dollar cost averaging going down. If you buy a stock at $100 and the price goes down to $80, it's better to sell that position and keep your cash. Fundamentally, then if the price goes down to $60 again, if nothing is fundamentally wrong with that company and there's no changes, you can now buy that stock at $60. But most important, you don't participate in all of that loss. So does that make sense to you? So it goes down to 80, you sell it. As long as you know it's a good company, wait till it goes to 60, then buy it again. You didn't participate in all that loss, but you're going to participate in all the growth as it goes back from 60 to 100. So this is what we call selling in the red, okay? Trader number one. All right, trader number two. Buy, sell, and regret that you don't make more money because you sold too early. All right, so do your research, find a stock, and buy that stock and sell that stock when it satisfies you. But don't buy it again if the price continues to grow, because if you don't participate in the entire growth, you risk participating in the entire loss. So the more important fact is that even if the stock continues to grow after you sell, you made a profit. And more important than all, you now have cash. So now you can go looking for another position where you can make another profit. Okay? So here's a question for you. If you buy a car today, will you sell that car in 1 week with a 30% discount? No, don't sell in the red. Okay? Now, these two are contradictory. Okay? But we're showing you two different ways. First one, sell in the red. Next one, don't sell in the red. Okay? Two different strategies. All right, here comes another one. This one's called trading hands, and it's called the process which facilitates the movement of money from new traders to the more experienced traders. How that process works is usually the new traders will buy a coin or a stock at a certain price. When the market experiences a correction and the price drops under the price where the new investor bought, an inexperienced investor, which is not familiar with market fluctuations, will sell to recoup some of the money. The experienced investor is ready with his money, waiting for the new investor to sell, and he will come and buy at the discounted price, that coin which was sold by the inexperienced investor. The experienced investor waits for the price to grow, and when the price is high, it will sell it again to a new investor. So I ask you again, if you buy a car today, you will sell that car in 1 week at a 30% discount? I don't think so. All right, some traders look at technical analysis and others look at fun. Technical analysis looks at graphics and tries to guess the next movement of stocks based on a graphic of the price fluctuations, whether it had it in the last hour, the last day, month, or year. This analysis tries to determine patterns of the stock price, and based on that, they try to estimate the next movement of the stock price. But we all know past performance doesn't guarantee future results. Fundamental analysis focus on the fundamentals of the company, like what the company produces. Is there a need in the market for that product? The product competition? Is there a future need for that product? Or will they have an edge over their competitors? This product has a demand now. Is it going to have a demand in the future? Is the product produced locally, or must it be imported? The entire product, or is it a component of that product? And it's very important to understand the fundamentals before you purchase a stock. When you understand the fundamentals, that means that you have done your due diligence and you start growing some convictions about the stock. It's the fundamentals for one company that are solid, and nothing fundamental happens. It's not a point to worry if somebody pumps the stock of that price up, and doesn't matter. You know your fundamentals of that stock, okay? So in this video, I've presented 3 different ways that actually contradict each other, some of them. So please, for those of you that haven't subscribed, hit that notification bell, subscribe, and then hit bell so you'll know when that video comes out. And please like and share. And also, if there's something you don't understand and we can maybe do some research together, remember, we're learning on this channel together. Join our community and hope you're enjoying these videos. So leave a comment. We appreciate it. Remember, keep it in the green. Thanks, YouTube. Have a great day.